is we are Group 51 and we are going to present on Weiss Multi-Strategy Advisor. So this is a New York-based investment management firm founded in 1978 by George A. So Weiss is the chairman and the CEO of the firm. The original business was built around the brokerage and the trading involved to hedge fund and the proprietary investment. So in this year, 2024, April 29, Weiss filed for the Chapter 11 bankruptcy due to several reasons. So total will be 3 reasons. For the first one will be it struggled to manage costs because having at least 110 employees including well-paid traders and a crowded back office staff. So for the Weiss expenses also spark concerns as there is a private plane that George Weiss used for the personal trip. Not only that, the high rental for the 20th and the 21st floor of its Park Avenue location alone also total nearly $3 million per year. So for the business model, for the firm typically take a multi-strategy approach, employing a variety of distinct investment strategies to achieve the desired result. And the financial was were exacerbated by its decision to stop charging clients for various expenses. So for the third reason about the leader, the John D. Weiser becoming a president and the CEO, several employees described that he is having a volatile tempo, frequently belittling colleagues in the meeting, who creating a challenging working environment to them. So his personal relationship with the Rothschild also raised the concept about the co-worker. So in conclusion that Weiss Multi-Strategy Advisor run by the George Weiss, CEO John D. Weiser, had a glimpse of the larger multi-strategy rival, but it led to discipline, so it due to the bankruptcy. So next, I will pass to Brenda to explain about the reason of the crisis.
Here are the identified key causes of Weiss institutional trouble, including high operational costs and unchecked spending, poor financial performance, poor leadership and management, as well as debt obligations and legal disputes. In 2022, Weiss Multi-Strategy Advisor LLC faced a major setbacks with a minus 18.48% loss in investment returns. While the firm saw a modest 10.52% recovery in 2023, it still didn't make up for the previous year losses, keeping investors still struggling. When we compare this to key market benchmarks, it's clear that Weiss lag behind. The MSCI World Index grew by 21.8% and the S&P 500 surged 26.9% in 2023, making Weiss' performance seems relatively weak. This raised a concern about whether the firm could keep up in the market with such a strong growth. Weiss' reliance on long-term U.S. Treasuries and corporate bonds proved risky. When the Fed raised the interest rate by a total of 4.25% in 2022, higher rates made newly issued bonds more attractive, causing the value of existing bonds like U.S. Treasuries to drop by minus 12.5%, which is their worst in decades. This revealed the Weiss' vulnerability to interest rate changes and lack of effective risk management. These missteps not only deepened the losses, but also meant that Weiss missed the 2023 stock market rally, and declining portfolio values eroded the investor trust, triggering the withdrawals that worsened the liquidity issues. Despite these struggles, Weiss didn't cut back on their spending. This firm continued to give out six-figure bonuses and maintain a corporate jet. This, along with an expense ratio of 3.14%, was far higher than the industry standards, making it difficult to recover financially. In 2023, the firm only managed a 3.27% return, which raised a concern about its financial discipline. Weiss' heavy reliance on illiquid assets like treasuries and bonds tied up the capital and limited flexibility. This further strained its ability to navigate the financial challenges and meet the investor demands.
Now, the third reason why Weiss failed is due to the poor leadership and management. their failure to take necessary actions such as replacing ineffective executive or implementing cost-cutting measure, and also they retain high compensation executive during underperformance. This highlight the lack of accountability of Weiss, and also their inability to restructure operation or reduce unnecessary expenses, leaving the firm vulnerable and unable to recover from the loss. Now, the fourth reason of Weiss bankruptcy is actually due to debt obligation and legal dispute. So Weiss actually filed for Chapter 11 bankruptcy in May 2024 to restructure their liabilities between 100 million to 500 million. And also ongoing legal dispute of over 30 million bonuses paid before bankruptcy further damaged the investor confidence in Weiss. And personal guarantee by founder George Weiss of over 100 million added financial strains to it. And aside from that, the failed merger between Millennium Management also lead to Weiss bankruptcy. So why does this merger fail? Is because due to strict demand from Millennium, which is including staff cut and changes in the leadership. And also they refuse to assume Weiss liability except for those key obligations. And concern over potential departure of key talents such as Andrew O'Connor has actually reduced the merger appeal, and this leads to the firm to face a significant credit and reputational risk, ultimately leading it to closure after 46 years of operation. Now, I'll pass it on to Zhe Xin to talk about the solution to overcome all these challenges.
I'm Zhe Xin. Now I will discuss how Weiss might have tackled the financial challenges that led to its decision to wind down operations in early 2024. Weiss faced issues such as high operational costs, underperformance, and significant debt, particularly over 100 million owed to Jefferies Financial Group. Here are 5 key strategies that could have been implemented to stabilize the firm's financial performance. Firstly, debt restructuring could have provided much-needed financial relief by renegotiating terms with creditors like Jefferies. Weiss might have extended repayment periods, reduced interest rates, or even secure partial debt forgiveness. These measures could have eased cash flow pressures. Additionally, operational restructuring was crucial. Weiss' multiple high-cost offices in cities like Manhattan and Miami, combined with a large workforce, created immense financial strain. By merging departments, reducing headcount, and replacing ineffective executive, Weiss could have significantly lowered its operating expenses and improved efficiency. Next, asset sales are a proven way to raise capital quickly. Weiss sold its Dassault Falcon private airplane in 2023 for $941,000 is an important step. Beyond this, divesting non-core business units could have allowed the firm to refocus on its primarily hedge fund management operation. This would have not only raised additional funds but also optimized resources for better financial performance. Cost-cutting was another critical area. For instance, Weiss paid over $30 million in bonuses despite its financial struggles. It is a move that was widely criticized. Aligning with bonuses with operational performance could have preserved financial resources. Downsizing underperforming departments and consolidating high-cost offices could have further reduced expenses. Relocating to more cost-effective locations is a common strategy for firms facing financial pressure and could have helped Weiss stabilize its operation. Transparency governance are vital for building trust with stakeholders. Weiss faced concerns about conflicts of interest, particularly between its chief investment officers and director of investor relations. Addressing these conflicts and ensuring executive decisions aligned with the company's objective could have restored trust, improving investor confidence, and potentially attracting new capital. Finally, engaging in proactive mediation with creditors, particularly Jefferies, could have prevented costly litigation. Settlement discussion not only reduce legal expenses but also provide a faster resolution, giving the company breathing room to restructure its finances. While Weiss ultimately decided to wind down, strategies like restructuring, divestitures, cost-cutting, governance improvements, and mediation could have provided a viable path to recovery. These measures, if implemented proactively, may have allowed the firm to stabilize its financial position and continue operation. That's all for my part. Now Fatahna will talk about the assessment of Weiss leadership effectiveness in addressing the crisis.
Assessment of Weiss Multi-Strategy Advisors LLC's leadership effectiveness in addressing the crisis. Strategic actions and ethical governance of Weiss. Weiss Multi-Strategy Advisors LLC demonstrated proactive leadership and effective crisis management through its flexible multi-strategy investment approach, enabling rapid asset allocation adjustments during market volatility. Diversification across asset classes, geographies, and strategies reduced risk exposure, while stress testing and liquidity prioritization ensured resilience and flexibility to capitalize on opportunities. The firm emphasized transparency and ethical governance by maintaining open communication with investors and adhering to a strict code of ethics, aligning decisions with stakeholders' best interests. Recent net selling reflected strategic caution and proactive risk management, fostering trust through transparency. Weiss relied on data-driven decisions and specialized teams to navigate challenges, prioritizing compliance protocols and talent management to sustain operations. These efforts were integrated into a broader crisis strategy to support long-term financial stability. Performance issues and financial challenges leading Weiss to bankruptcy. Despite these efforts, Weiss struggled with underperformance and financial mismanagement, leading to its closure on 1st of March 2024. The firm announced plans to shut down operations, return client capital, and filed for Chapter 11 bankruptcy in April 2024 after evaluating its options. Management's approach reflected a focus on transparency and structured decision-making, including engaging legal and financial experts to manage creditor obligations and oversee their restructuring process. Key challenges include underperformance and financial struggles. Financial management challenges were evident as Weiss managed $3.1 billion in assets by mid-2023 but faced debts of up to $50 million and total obligations reaching $500 million. Although the decision to wind down operations suggested a calculated approach to minimize further losses, earlier proactive measures or restructuring might have averted the bankruptcy. Now, I'll pass on to Nisa to summarize our discussion.
In conclusion, the organization faced significant financial and operational difficulties. Poor performance resulted from excessive costs and inadequate financial control. Rising interest rates compounded these issues, reducing returns and creating additional pressures. Leadership, particularly Josh Weiss and Jordi Weissers, struggled to implement effective cost-cutting measures or restructure the organization to address these challenges. Internal conflicts and ineffective leadership further weakened the organization. Distrust grew and debt pressures intensified as leadership failed to renegotiate terms with creditors. The flawed merger with Millennium Management not only failed to provide relief but also introduced complexities that worsened the financial situation, making recovery even more challenging. The lack of proper risk management and strategic planning was another critical issue. There was no diversification in investments or stress testing for rising interest rates. Weak internal controls and the absence of a crisis management strategy left the organization vulnerable to external risks and unprepared for potential shocks. In summary, addressing these challenges require immediate action. Risk management must be strengthened with regular stress tests and diversification of investment. Leadership should resolve internal conflicts and focus on restructuring the organization. That's all from us. Thank you.